Hey everybody, this is Paul doing another dividend video here, hopefully kind of quick. And just want to go over the market, just new positions that I've added, just pretty much anything different and kind of where I think everything's going here. Um, so let's go over the new positions that I added so far. Um, Last week on October 7th, I added CVS, as you can see here. That was the day that CVS announced that they were buying some kind of Cantro healthcare company or something like that. And the investors tanked the stock by a significant amount on that day, 12%. So there's certain stocks that I've been looking at but have been too expensive. So CVS is definitely one of those stocks where it was trading before this news. It was trading around $100 a share. I've owned CVS before. I sold it, took some profits, and pay down some debt or whatever, but I wanted to get back into the stock, but I wasn't getting back in when it's $100 a share. So what I did is I waited and I got lucky. It just happened to sell off in the exact same day that I put a price target out on Twitter that I would buy it at. And it fell into that range, and so I bought it. McDonald's is yet another one. Pretty much exactly the same situation happened. Basically, it opened at a very low price. There's still lines going around McDonald's wherever I'm at. Even if we get into a recession, they have pricing power. I believe they're just miles ahead of like just different places like Burger King, that kind of stuff. Like if people stop doing like fancy fast food restaurants, they'll still probably end up doing McDonald's for just like their dollar menu or their $2 menu, that kind of stuff. So I see McDonald's doing a definite shift. More into automation also. That's something to look out for. You can kind of see that they're moving more into like a having their employees focus more on like deliveries and drive-through. And then like whenever you enter a McDonald's, there's like a automated kind of thing where you can, instead of having to wait for a person to do whatever, ring you up, you can have these little things now where you just kind of put that order in yourself. I see some older people having trouble with that still, but it's definitely a transition that is occurring. So McDonald's definitely got added. I would like to add more if it actually pulls back, maybe on earnings, or if we actually get into a recession, which I think is still going to be in 2023. There's nothing here that's telling me it's going to be this year at all. You might see a slowdown, like kind of a start to slow down, but I mean, you have Christmas holiday, you have Thanksgiving, you have all that coming up, and the job market is still ridiculously strong. So even if the Fed does hike another 75 in November, which they will, and then the market is now pricing in another 75 for December, which is actually quite amazing because it was supposed to be 50. Um, Even if they still do that, I think some of these companies like CVS, McDonald's, that type of thing will be just fine. Um, so those were the two I added. So where did I get the money from that for? Basically right here out of QYLD. Um, this is a position I've talked about it before. Definitely fell for the pivot narrative in April, or actually in or March, because I didn't think the Federal Reserve was just going to let the market go the way that it has. But they definitely changed, and I got into these positions. These are the ones that QYLD, BST, and these right here. These are the ones that kind of got me really bad. So I've wound down this position over time, trying to reduce my losses, but there's only so much you can reduce. Um, so if you go to my gains and losses, it's pretty rough right now for 2022 because I just got out of positions. I did get out of things like Target before it like got cut in half basically. So I avoided some very serious losses comparing when I sold the stocks, even though I sold some of them at a loss, compared to what they ended up going to throughout the rest of the year. So I definitely avoided some pretty rough things that I would have been forced to hold that I just don't think are going to perform well in a recession. So, well, I guess I wanted to go over what exactly happened yesterday. Um, and right now, so as you can probably guess, the the you have headline inflation, which includes everything, which includes gas, or which includes energy, that type of stuff. and it includes food. And then you have core inflation. Core inflation is the thing that includes the things like rent, used cars, airline tickets, that kind of stuff. So what's going on right now is headline inflation is coming down, but the things that drive core inflation are still going up. And the reason why they're still going up is because the data is ridiculously lagged. Now, the data regarding like airlines, that seems to be pretty accurate with what the airline CEOs are saying. They're still seeing a large amount of demand. But in the rental market is a complete mess right now. Anybody that does, like if you look at the people that actually do the rental, like rental type things, like Redfin, any of the big CEOs, they're telling you that they're starting to see a lot of apartments opening up. They're starting to the housing market is completely frozen right now. House prices have stopped going up. They're, if anything, in a lot of places they're going down. As houses literally just get put on the market and sit there because nobody's buying a house at a 7% interest rate unless you're buying it for cash, basically. So the market is kind of sniffing out peak inflation, as in like it went up, it hit the maximum amount that it's going to hit around June, and then it's been falling since. But you also have the Federal Reserve kind of in the back that's raising these interest rates up to levels just not seen for a significant period of time when we were 31 trillion less in debt, which is another major problem that we're going to have. So right now, so let's go over what happened yesterday. So that's how I can kind of tell you, like when I look at everything, that a lot of what you're seeing with these big rallies is all just technicals. And what technicals are is people that draw lines on charts, basically, I guess is the best way to describe these people. But the computers and the algorithms have to be programmed with something. So it's either you program all the computers to say, well, when this hits this certain price target, buy it all. That's we call that you can put in a stop or you can put in a buy order at a certain price. Well, the way the computers work is basically they go by different levels and they look at where the market last fell, that kind of stuff. These are called Fibonacci levels. And what these are is you can draw these on a chart. You just basically put where you want your starting point to be. So this was the low of 2020 right here. If you see this right here, 2191. There's some crazy people saying we're going to get back to that level, which is, just remember what it took to even get to this level. It took 21 million people being unemployed. That's Great Depression territory right there. It took $6 trillion to get from here to there. Just remember that. From this little bottom right there to probably right about, well, actually up here, but just to get from here to there, it took about 3 trillion, give or take a little, overnight. And then to get from there to there, it took another 3 trillion. So just to give you a general idea, kind of what it takes to get out of these slumps. And I don't think we're going to see another 3 trillion like that for a very long time. So what happened was basically yesterday when the CPI report came out, very bad, across the board bad. Nothing's falling like they need to. The bond market started pricing in much higher rate hikes, 75 basis points in November, 75 basis points in December. This is going to kill. The housing market's dead. The IPO market, like new companies coming onto the market, they're dead. They can't get money. High yield, if you look at high yield right now, this was right here during the financial crisis in 2008. This hit $61. This was going down at a pretty significant rate. Everything across the board was going down. Everything was extremely oversold. It's just a simple problem is when you look at the actual earnings of companies, they haven't completely fallen apart yet. So JP Morgan Chase still tops estimates. Now they're worried about the future. You still have big companies like Kroger. We're going to buy our competition. We smell weakness. We're going to buy our competition. The ones that are really adjusting are the companies that weren't profitable to begin with. So they're the ones who are doing the employee cuts. So if your company's not profitable at all, this right here is kind of a headline that's going to be on top of your company pretty soon. Because all that refinancing of the debt that people did during the 2000 or 2020s and all that, when rates were super low, it wasn't just normal people refinancing their houses, it was company refinancing their debt too, out to 2024, 2025, that kind of stuff. So we haven't gotten to the point where companies need to refinance at these debt levels, which will be really, really bad. Be really, really bad. The Fed is actually hoping that by the time some of that starts to hit, that they've at least cut rates by then, and maybe it won't be so bad. It's going to be bad either way. So what happened is basically the market yesterday opened with that horrible news, and the bears tried to go all in and the bears basically tried to go in and crash the market. So it was selling, 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 and then we hit this exact level, which is 50% higher. It's kind of a weird way to say it. 50% higher. It's called a 50% retracement from where the COVID lows were. So you would have to go like right about here to get to the 25% level, I believe. And this is the 0 right here. So here's 50. 25 would be right about here. She didn't mark it on this. This is Liz Young. Very good person on Twitter to follow. But 50 would be right about, or 25 would be right about here. So when we hit this level, that is it's called a major support level. And as you can kind of see right here off the COVID lows, we hit it right here. You can kind of see when you're hitting these levels. On the way up, they kind of fell back through it, but as you can kind of see right here, when the minute we hit that, and that's when I don't know if the computer algorithms or the guys who run the algorithms sat there and said to themselves, there's no reason to go any lower. You can't. There's nothing to justify going lower. Earnings are still high. All the major companies, they're still hiring. They're not doing any firing yet. Now, they might be slowing down hiring, but nobody's firing yet. The only people that are firing are the ones that are just that were in front of the pandemic boom. So they have companies that really, really benefited, like Intel, which I own, by the way. So that's kind of what happened yesterday. There was no fundamental reason why that happened. It's not like we have a rosy outlook and everything's great. If the 10-year reversed, that was above 4%, but that's still going to be above 4% very soon. So, and one thing that's going on with the bonds is basically every time the 10-year hits 4%, everybody comes in and starts buying because they think that's about as high as it's going to go. And this is going to be kind of a similar situation with the 2-year here pretty soon. Everybody comes in and starts buying. The problem is when everybody thinks that everything's done going up, that's when things start going in reverse, and that's when you're in a recession because the 10-year very, very quickly goes below the 3-month, and that's typically your kind of sign that people are getting out of stocks, going into bonds kind of thing. That's your ultimate safety trade when they think that these things are done going up, because you don't want to be holding a bond that becomes worthless because this is what happened in the UK. You're holding things at like whatever this rate, and then it goes up to 4%, and then you try to get rid of this, and who's going to buy that when you can get a bond for 4%, right? So in those situations, those guys were holding stuff that was like 0, like 0.25%, and they were trying to get people to buy it, and it's worthless now. So it became a worthless asset. So that's kind of where we're at in the market right now. Where do I think we're going to go? So it's pretty obvious. We're going down in a pretty predictable path, actually. So anything that involves debt basically is getting hit. So anything that involves free money. IPO market, these are companies that are not profitable, but they might be profitable someday. That whole market shut down. Venture capital money, these are the guys that throw money at bad companies. There's so many companies you probably never even heard of. In Silicon Valley, the Silicon Valley millionaires, those guys, the different Bitcoins of the world, like the different coins, that type of stuff, those guys, that money's all shut down right now. And there's literally no profit unless something comes to market that, they can borrow at whatever 4 or 5% and then make a profit of higher than 4 or 5%. So that whole market's basically shut down. The next market that kind of go is anything sitting in high yield. And you can kind of see it on days where we sell off anybody that has high yield debt. So you've noticed, so if you've probably noticed, I hold some of these companies actually. AT&T is a good example. Just companies that have a lot of debt, require a lot of debt financing. The airlines that were holding a lot of debt, the cruise ships, that type of stuff. So any company that's holding a lot of debt is getting hammered whenever you see these sell-offs in like HYG and LQD. So that's kind of the next market to fall. Um, we're kind of getting into trouble when this starts to really just go really bad. And you can kind of see here. So when the Fed goes through with their November hike, this will probably take another leg lower. And then if they go through, because the next panic, as you might want to say, is going to be, will they do 75 in December? Will they do 75 in December? Will they do 75? They're going to do 75 in December. Okay, that's just going to happen. Core CPI and inflation are not going to be low enough by that point, and the job market is still going to be healthy because you're going to have seasonal hiring. So unless the job market just magically collapses between now and December, or inflation magically comes down between now and December, but that's not going to happen because heating costs are going to go up because it's cold outside. So especially in the Northeast, is going to be huge demand, and especially in Europe. So that's kind of it's just not going to happen. So you're going to get a 75. So what's going to happen is you're going to see high yield get really hit. So I really expect to get really hit on things like AT&T, that type of stuff. As they kind of restructure the company, become more of a utility again, and get out of the entertainment business. Focus on phones, focus on internet. Basically their utility roots is what they're going back to, and that's what they need to do. And then deal with their debt in the process. They'll be fine. People expecting them and Verizon to go out of business and then have T-Mobile as the only company, that doesn't even make any sense. T-Mobile couldn't even come in here. T-Mobile had enough problems buying Sprint. It took them 5 years or something crazy like that to even be able to get approval to buy Sprint, and even then they had to spin off parts of it. Anybody saying that AT&T or Verizon is going to go out of business and T-Mobile is going to take them both over is insane. They just don't make any sense. Maybe if you get a Republican president, a Republican Senate, a Republican FCC, and a Republican this, but even then, people there would be like, that's crazy. You can't just have one company and like two companies. That's crazy. We haven't even let the airlines get that small. So I just don't see that happening. Maybe you never know. Maybe Verizon comes in and buys AT&T. But why would Verizon want to get into the internet business? Or maybe they would. But AT&T does a lot of like physical infrastructure internet wires that go into your house. T-Mobile and Verizon don't do that. So you would have to break up AT&T into multiple parts, and then somebody would have to take over their debt. It would just be a mess. It could happen if it got bad enough, but I just don't see it happening. But I don't know. This could end up being a massive loss for all I know. But I just don't see it happening quite yet. Maybe in a few years. If they have to refinance that whatever ridiculous amount of money they have at these higher rates, yeah, they're probably in trouble. But they would just raise their prices. So, I don't know. We'll have to see where that goes. But right now, the plan is to just keep adding to different positions. QYLD has been drawn down as far as I'm going to draw it down. I've actually turned on dividend reinvesting here because this is drawn down more than enough. This is only 5% of my portfolio. It used to be like 50% of my portfolio or some crazy number. So that's where we're at right now. I got out dividend reinvesting on every single thing. So far for the month of October, I am up 3.56%, which is pretty good. I'm expecting those gains from yesterday to get reversed out, but we're going to have to see. So that's kind of where I'm going to leave this video right now. As it stands, I just kind of see the market maybe trading sideways, maybe trading a little up going into year end. But for 2023 is when I really think like that's where the Fed hikes are really going to start to hit like a hammer, especially if they stay consistent with them. So, and that's not even including like some geopolitical event, like Russia setting off a nuke underwater or something crazy. So I just don't see the crash scenario that a lot of people are seeing. Um, I'm just seeing it just kind of looks like the slow grind down, like the slow the so this is kind of like the bear scenario. So you see this big bear scenario right here where it kind of like does this like big crash. This is what these guys are looking for. They're looking for something big like that. And these types of things take huge events to do. There needs to be something huge. We're just not at that point. And then this is the bull case, is that you basically trade sideways, and then once the Fed says they're done, you start going back up. So you have to figure out which side you're leaning on. A lot of people are drawing a lot of parallels to this little section of the map over here because a lot of things are starting to point out. There's a lot of things pointing to this, but there's some things pointing to this, but not really, because we're not having this. This took a lot. This took a worldwide systemic event that's just not there anymore. So it could be there, but we're kind of leaning towards this one right now, the 1962 example, where it's kind of like you trade sideways, and then once the Fed's done, once inflation comes down, that's where you take off. And you're going to get this, you see this major line up right here. You're going to get that major line as soon as the minute they say that they're done. So that's where we're at right now. 2023 still looks to be where the action's at. If we get into a recession, you're looking at another 10% down, just how it works. Probably 10 to 15% down, to be honest with you. If you don't get a recession, we basically trade within this range until the Fed is done for a long time. um, yeah, we basically trade in this range. But everybody's predicting a recession, so that 10 to 15 is a real possibility. So just be aware. You put money into this market, and I should have said this at the beginning of the video, but there's still a chance, and I will put this in the description of the video, there's still a chance 10 to 15%. So don't put money in this market if you can't stand to see a red number on the screen. That's just all I got to tell you right now. If you can't stand this, if your portfolio looks like this, and it is nasty, and if you can't keep adding at these levels, just don't. Just put it in cash and just sit and wait. Um, your your trigger will be when the Fed says that they're done. When the Fed says they're done, that's when you know the next step is actually a cut. Try and stimulate the economy that they've slowed down. That's what you're waiting on. You might not catch the exact bottom, but it's kind of what you're waiting on if you're in cash. So hope everybody has a nice day. I'm going to use the numbers from yesterday to put on the title of the video since it's kind of swinging around right now, and I think that's kind of crazy to do anything like that. So that's where we're at right now. Just let me know what you think in the comments. Have a nice day.